Welcome to the Ultimate Technical Analysis Trading course. If you're someone who's looking to master technical analysis and get really good at spotting trade opportunities in the market, then you're in the right place. You see, the problem is a lot of traders don't know how to use technical analysis properly, and they're constantly losing money and they're struggling to become profitable.
Why did that happen?
I've seen traders spend the past 2, 3, 4 years of their life dabbling with their idea of technical analysis and never really getting anywhere. They never really find that breakthrough. Let me give you an example. Let's say you give the average 7-year-old $1 million. What is the likelihood? What is the probability that that 7-year-old would be able to take that money, make a business, and flip that money and grow it to $10 million, $20 million? It's next to impossible. They literally have the tools right there in front of them. They have the $1 million sitting there right in front of them. But if they don't know how to use it properly, it's going to be very hard for them to grow that money into something substantial. Let me give you another example. Take a look at the average lottery winner. They win $100 million, $500 million, $800 million. Most lottery winners that win the lottery always end up going back to square one. They always end up being broke again. Why? They have the tools, they have all the money, but they just do not possess the knowledge on how to take that money and grow into something substantial. And the point I'm trying to make is it doesn't really mean much to have the tools if you don't possess the knowledge on how to use them the right way. And it's the same concept for trading. You can have all the tools of technical analysis, the chart patterns, the candlestick patterns, the indicators, but if you don't know how to use them the right way, then you're not going to find success in the markets. And in this video, I'm going to show you exactly what the tools are of technical analysis and how to use them and how to combine the tools together so you can find success. So let's go ahead and get started. Technical analysis is split up into 4 main categories, and I'm going to break all of these 4 categories down for you step by step. And by the way, if you like content like this and if you want me to do more more trainings like this, let me know in the comments below and drop a like if you find this type of content useful. And by the way, if you aren't subscribed to this channel already, go ahead and subscribe because we release trainings just like this on a consistent basis. And for those of you that are subscribed, make sure you hit the notification bell so you don't miss out on any future videos that we release. So let's go ahead and break down these 4 categories. The first one is candlestick patterns. The second one is chart patterns. The third one is technical drawings. And the fourth one is indicators. So if you're taking notes, these are the main topics that you want to write. Now, the entire purpose of using technical analysis, and I want you to write this down, is this alone. There's a few things we use technical analysis for, and this is what's going to help us trade. The first thing we use technical analysis for is to understand the market structure, is to understand the market condition. We use this to think to ourselves and visually see, is a market consolidating? Is a market trending up or is a market trending down? The second thing we use technical analysis for are all 4 of these different categories. We use this to find our zone of interest. What area, what relative area are we looking to find our trades in? And the third reason we use technical analysis is to find what's called our entry trigger. This is to help us identify where we want to enter our trade. The next thing we use technical analysis for is to identify an area of where we're going to put our stop loss. Or in other words, where in the market does the price need to reach in order for our trade idea to be invalidated. The last thing we use technical analysis for is to find what's called our take profit. Where are we going to close our trade if the price does end up going in our favor? And for those of you who watch my other videos, you might have realized that all 5 of these things spell out an acronym, MZEST. I'll link that video right above my head so you can watch that video as well after this one. So we use those 4 key categories, the candlestick patterns, the chart patterns, the technical drawings, and the indicators to help us find the components to enter a profitable trade. So let's talk about the first one. The first one is candlestick patterns. Now, whenever you're looking at a candlestick chart, you'll usually see a bunch of candles that are green and red, and they're all moving up and down. And these candles have significance. If you can understand and interpret these candles, you can use these to your advantage. So let me kind of explain what this means. So first and foremost, any green candle that you see just like this, the green candles, these are essentially telling you that the price was bullish during this moment. The price is going up. Anytime you see a red candle, this tells you that the price was going down. For example, this current candle in this current time period right now, the price has went down from the point where this candle has started. Let me kind of explain this in a little bit more detail. So right here, I've drawn 2 candles. One candle is bullish, which is the green candle, and the other candle is bearish, which is the red candle. So pretty much what these candlesticks mean If it's a green candle, that means the price that the candle started on started at the bottom of the actual body. So in this case, it's a green candle, and I want you to look to the very right over here. This candle started at the price of 1.08972, and you'll notice I am currently on the 1 hour time frame, which means when this hour had ended, the price ended up settling at 1.09056. Now, these wicks have significance as well. The wicks mean the price, even though it started right here and even though it ended right here, that means within that hour, the price continued to be a little bit more volatile and actually pulled the low for that hour to this price, which is 1.08947, and it pulled an all-time high during that one single candle at 1.09082. So this essentially tells you the story of the price movement within that 1 hour. Now, every time you see a red candle, this is a bearish candle, which means the price has always started at the top of the body. Price always starts at the top in a red candle, and the price always settles in, finishes, closes at the bottom of the red body over here. And these edge things are called wicks. So the story of this candle right here, the price started right here at 1.09056, and the highest point during this 1 hour, the price was at 1.09084, and the lowest point during that time, the price was at 1.08948, until it finally, at the end of that hour, the price got pushed up just a tad bit and finally settled in at 1.08973. I want you to take a look at right here where it says OHLC. This stands for open, high, low, close. So whenever you're looking at a chart and you see these OHLCs, you can just simply hover your mouse over a candle. I'll give you an example just like this. I'm hovering my mouse over this candle, and this will tell me what the open price was, what the high price was, what the low price was, what the close price was. You'll notice those numbers will correlate to the open, high, low, and the close. Because remember, this is a green candle, so it closed above. This current candle that we're on right now, the open was right here. The high, if you can kind of see, there's a small little wick. The high was right here, and the low was at this wick. And right now, since the candle is still moving, we are still currently in the hour. There's 52 minutes still remaining of this candle. The close, the red body, is continuing to move. One thing to note, if the candle does end up going up here, if the price continues to push up, this red candle will turn green. Now, what is the benefit of using a candlestick chart? Why not just use like a regular line chart like Robinhood has? And the reason is, this is a method of reading price action on a physical chart. We use the open, high, low, close to identify the potential movement, the strength, or in other words, the momentum of price on the actual charts. And how do we do this? We do this by looking at the relationship between the wicks and the bodies on each individual candle. Let me kind of explain what I mean. Take a look at these candles over here. These candles tell us a very specific story that is important for price action. This first candle, we know because it is green, we know the price action started down here, and because of this wick up here, we know the price pushed up to a high over here, and because the body ended right here, we know the price pulled back down, reversed, and closed over here. So even though this is a green candle, one might think this is a bullish candle. It's green, right? So it has to be bullish. The price is going up. But the reality is the movement of price during this time period actually was this. I'm going to draw this out with a line chart. Let's think of this as a line chart. The price started down here, went all the way up, and then went all the way back down. So at one point, the buyers were indeed in control. The buyers were indeed winning. But what ended up happening is these sellers came back in and pushed it all the way back down. So you can kind of notice this candle did somewhat of a reversal. So you can just imagine if the price action, let's say the previous candles were over here and they were slowly creeping up higher and higher and higher and higher and higher until this green candle went up, then it came all the way back down. The buyers were initially all the way in control until this wick ended up pushing this candle back down. And now this candle has a probability of reversing and going in the opposite direction in the future candles. Same concept for this one over here. What happened here? This is a red candle, which means the price started up here, the price went all the way back down here, and the price closed right over here, which means the sellers were initially in control, and then the buyers pushed back up and closed the market over here. So if the previous candles were coming up from here, pushing all the way back down, and then we saw this huge reversal, there could be a probability that the market could reverse over here as well. Now, the same concept of this one over here. Even though this is red, the market started up here, went all the way up here, and then it closed all the way down here. So this is a bearish candle, just like this green one over here. So this red one and this green one are essentially very similar, except this red one has a little bit stronger of a bias pressure. Because what did the price action do here? The price action started up here, went all the way up, then the sellers came in, pushed it all the way back down. So now the price ended way over here. This can give you a clue of where the future price action might be moving, depending on where you found this in the actual chart. Now, if you combine two candles together, you can get an even stronger picture. Let me kind of explain that for you as well. So this right here is what we call a bearish engulfing candlestick pattern. What does this mean? This means the price started here, and it's green. That means the price ended way up here. And then the next candle, or in other words, during the next hour, the next candle started up here, and these sellers came in, pushed the candle all the way down, and this body completely engulfed the green candle's body over here as well. So this shows another potential sign of reversal. Why? Because the buyers were initially in control. However, the sellers came in, stepped up, and then pushed it all the way back down, engulfing that first candle. This next one here is what we call a bullish engulfing. Same exact concept. The sellers were initially in control, but now the buyers kicked in and pushed it all the way up and pushed it so strong that there is barely or very minimal wick at the top that is showing a lot of buying pressure and is showing a lot of momentum to the top side. So this also shows the potential sign of reversal as well. Now, these are what we call 3 candlestick patterns. Let me kind of explain what's happening here. The price was moving up, and then the second candle gained a lot of momentum, meaning the buyers were even more in control. And then this third candle ended extremely bullish. The buyers gained momentum. There's a lot of momentum gain here. So this could show a very strong bullish signal for the future price action. This one right over here, this is what we call an evening star. Why? Because what happened? The bulls were initially in control. This small little candle right here, this shows a sign of indecisiveness, meaning the bulls and the bears, they're both kind of unsure of where the price action might go. And then the next candle was very bearish, and this next candle actually closed below 50% of this first candle. Now, if this candle was even deeper, even more red, and had a lot more selling pressure, this could show a huge sign of selling pressure. This also shows a potential sign of reversal as well. So to recap, what do we use candlestick patterns for? We use these as entry triggers to enter our trades. These are essentially confirmation triggers. These are essentially other confluences, things we use in our trading to make sure the trade gives us a high probability setup. Now, some very powerful candlestick confirmations that you can use in your trading are the hammer candlestick, or the shooting star, or the bearish engulfing, the bullish engulfing, the 3 white soldiers, the 3 black crows, or the morning star, or even the evening star. As long as you can identify these candlestick patterns in a zone of interest, you have a very high probability trade setup in your hands. Now, let me just quickly give you a couple examples so you can see this in action. This right here, what do you see? This is a hammer candlestick pattern. Why? Because we see a relatively small body, and we see a massive wick. So what ended up happening here, the price action started down here, went all the way down, and then the buyers kicked in and pushed it all the way back up and ended the candle green. And what ended up happening with the price action, the future candles ended up going way up here, giving you 1,000 pips. Let's do another example. What do you see over here? This first candle was red, it was bearish, and then the next candle was bullish, and this green candle engulfed the red candle, created a bullish engulfing pattern, and then the price action continued to go higher and higher and higher and higher and higher. What ended up here? Here you see what's called a shooting star. What ended up happening here? The candle started up here, wicked up, and then it closed down here, and then the next candle melted. I'll zoom in so you can see the next candle started here, and then it ended way down here, giving you over 200 pips. What ended up happening here? Same hammer candlestick pattern, and the price continued to go higher. Same exact thing. What ended up happening here? The price was going down. This green candle engulfed the red candle and continued to go up. What do you see here? This is what we call an evening star. We first had a green bullish candle, and then the small red candle opened and closed roughly in the same area, yet it also created a shooting star pattern. And then the next red candle pushed the price all the way down, closing over 50%, meaning if you think of this as a halfway point, this closed below the halfway point of this green candle. And the next two candles continued to melt, giving you, if you entered on this trade, giving you around 150 pips on that trade. So now that we understand candlestick patterns, let's take a little bit of a broader look and look at what we call chart patterns. And this is essentially looking at a chart holistically, taking a look at a bunch of candlesticks that are adjacent to each other and seeing what the price action is telling us. Now, there are a few different subcategories of chart patterns. We could have what's called continuation patterns. We could have what we call reversal patterns. And we can also have what we call bilateral patterns. And let me tell you a little bit about each of these. First one we'll talk about is the continuation patterns. There's a few different patterns you can find in the markets. One easy, simple one to spot is what we call a bullish flag or a bearish flag. This is a continuation pattern. Essentially, what the price action is doing, let's say the price action started up here, price is going down, and then the price has trouble or struggles to reverse before continuing to go down even further. Or the opposite side of this, a bullish flag would be price action is going up, has some trouble reversing back, and before continuing in the direction it was originally going. And you kind of see that this area right here creates somewhat of a flag shape before continuing in the direction it was already initially going. Now, one key factor you can use to identify these type of chart patterns is to, once you see the price action is bullish on the way up, for example, you want to look for smaller candles. In this case, smaller red candles trying to push it down, but they're not big red candles. They're more small candles showing sign of weakness, showing the sellers or the bears are not really in control too much before the buyers come back in and push the price in the original direction it was already going. Let me show you an example on the chart. So right here, we see the price is heavily going down. There's a lot of selling pressure. And then once the price is kind of reversing back up, notice all the green candles, they're all relatively small. They're small green candles. And the red candles throughout this range are long red candles. They're pushing the price down even further. And you'll notice the price continues to go in the direction that it's going. So essentially what the price action is doing, very strong push down, and is having trouble going back in the opposite direction before continuing on the way down. This is what we call a bear flag, which is an example of a continuation pattern. Now, the next category is what we call reversal patterns. There's a few type of reversal patterns that we use. A few simple ones are, let me go ahead and erase all this stuff here. First simple reversal pattern is what we call a double top or a double bottom. What does this mean? This means the price was going in a certain direction, and the sellers came in, pushed it down before the buyers kicked back in. And now the buyers had trouble pushing the price even further, meaning they couldn't push it any further than the previous high, which caused the price to continue all the way back down. And it has created what we call a double top. Now, a double bottom, same exact concept, whereas the sellers are in control, the buyers kick in, the sellers push it back down and aren't able to push it down even further, and then the price continues to go all the way back up. So this shows you a potential sign of a reversal as well. So let's talk about a couple examples so you see this in action. So what we see here, we see the price is pushing up, so the bulls are in control, and then the price ends up rejecting at this point, continues to go down, and then the bulls push the price back up, and they have trouble breaching this same point over here. And now the second time, the sellers come in, the bears come in, push the price back all the way down. This right here is a reversal pattern. Now let me give you one more example of the same type of concept, but this one looks just a little bit different, but it represents the same exact thing. Now, right here, what's actually happening is the price action is moving down, so these sellers are in control, yet they had trouble breaching this low over here. The buyers came in, and then these sellers pushed all the way back. Even though the price wicked below this zone over here, the buyers came in and the candle ended up closing at the same exact level over here before the price reversed to continue to go back up. This right here is also what we call a double bottom. I'll just represent it using these arrows right over here. Notice the price reversed and continued to go in the direction of the reversal. Now, another reversal pattern is what we call a head and shoulders pattern, or an inverse head and shoulders pattern. Now, what a head and shoulders pattern looks like is like this. The price action goes up, price action falls back down, the next high is even higher, and then the next low is usually around the same price point as the previous low. And then the next high ends up creating what's called the right shoulder, which is roughly equivalent to the first shoulder before the price reverses and continues to go down. Notice what is being created here is the first left shoulder, we have the head, and then we have the next right shoulder. And the psychology behind this price action pattern is the price pulled a high and then a low, and then the buyers pushed it up to create what's called a higher high, and then the next low was equivalent to the first low, which means the price action got pushed all the way down to a level that's equivalent to the previous low, and then the next high that was created wasn't able to create a higher high, which shows a sign of weakness. It shows a slowing down of momentum for the bulls, and the bears are now in control, pushing the price all the way down. Now, obviously, the reverse of this pattern is the same exact concept. The price pulls a low, a high, a lower low, and then a high that's equivalent to the previous high, and the next low is roughly equivalent to the other shoulder, whereas the price reverses and continues to go in the direction of the new higher high. Now let's take a look at this on an actual chart. So we have a head and shoulders pattern over here. Pretty much what the price action is doing, the price went up, went back down to what we call the neckline, and the price pushed even higher to create the head, and the next low was equivalent to this point over here, which finalized what we call the neckline, and now we finally have the right shoulder. Notice the price had trouble breaching or even reaching a price point equivalent to the previous high. It was only able to reach a point that was equivalent to the left shoulder before it plummeted and continued to go all the way down, creating what's called a reversal pattern, such as this head and shoulders. Now, the third subcategory of chart patterns is what we call a bilateral pattern. And pretty much what this means is the price can go either way after this pattern is created. The price can either go up or the price can either go down. So you can't really predict which direction that the price is going to go. But once the price does exit this pattern, this shows a very good sign of a potential trade to enter. Let me kind of explain what I mean. So usually whenever you see these type of patterns, what the price generally does, the price generally essentially squeezes into a small little tight price action before potentially either pushing up and exiting the pattern, or it pushes down and exits the pattern. Essentially what is happening here, the price is consolidating and getting to a point where there's a lot of pressure built up before the price exits the consolidation and goes in one direction. So some of these consolidations could be called rectangles, where the price is just consolidating evenly, or which is a little bit more complicated to find, is what we call a symmetrical triangle. Let me go ahead and give you an example of that. So we see a symmetrical triangle being formed right over here. We see the highs are getting lower and lower and lower and lower and lower. So you can see the price action is indeed forming lower highs, but what's also happening with the lows, you can notice the lows are getting higher and higher and higher and higher and higher and as well. So what the price action is doing, it's actually squeezing in between these 2 points over here, and the price has a potential of either exiting the top or exiting the bottom. Once you see a pattern like this is what we call a bilateral pattern. The price can swing either way. But if you do find this pattern and you are on the right side of the trade, you can make a lot of great pips using this pattern over here as well. Now, what is the main point of using these continuation patterns, the reversal patterns, and the bilateral patterns? The main point is to assess the market condition, to assess what's actually happening with the market structure. And we also use these to identify potential areas or structures of where we want to actually enter the trades. This essentially allows us to get a quick assessment of the strength, the weakness, or the equilibrium of the market. And the main chart patterns that we use are a bull flag, a bear flag, a double top, a double bottom, a head and shoulders, or an inverse head and shoulders, or if you can even find an ascending triangle, a descending triangle, or a bilateral pattern is what we call a symmetrical triangle as well. Now let's talk about the third category, is what we call the drawing tools. Now there are a few tools that we use that we draw on the actual chart to give us an idea of where the price action might be going. Some common tools that we use are trend lines, we use what we call channels, we use what we call fibs, and we also use what we call support and resistance zones. And let me go ahead and talk about all of these. So the trend line tool, you can access that right over here on the left side. You kind of see where it says trend line. Once you have that selected, essentially how we use a trend line tool, we're essentially using it as a reference point of where the price might react in the future. Let me go ahead and give you an example. We see the price is creating highs that are getting lower and lower and lower each time. So what we would essentially do, we can create a trend line connecting all of the highs together. And once we have all of the highs connected, this is essentially giving us a potential area or some guidelines of where the price might react in the future. So if we see the price approaching this area, it could be a potential sign that the price might react on this trend line in the future as well. So let's go ahead and play this out and see this in action. We see the price touch this area. So if we are looking at this trend line for a potential reversal, we could enter a sell on this trend line using this as a reference point where the price action might have trouble breaching. Now, another tool that we use is we use what we call a channel. So what someone could do, someone could simply draw a trend line, just the same type of concept that we were doing before. We notice the price is creating lows that are getting higher and higher and higher and higher. And you can notice the price is respecting the trend line. But we can go a little bit step further and create what's called a channel. There are many different ways you can create a channel. You can play around with the tools. I just use this tool over here to create my channels. And essentially how you would create a channel and why it's useful is we have a lower bound and then we also have what we call an upper bound. So right now I'm creating the trend line for the lower bound, but now we can also see that the price is also respecting somewhat of what we call the upper bound. And why is this useful? It's useful because each time the price approaches the bottom, this could potentially give us signals or areas to enter buys. And every time the price approaches the top of the channel, this could give us areas to take profit, to close our trades. So if you see a channel that is ascending, the channel that is going in the up direction, it is wiser to enter your trades in the direction of the trend. So in this case, would we want to enter buys or would we want to enter sells in this case? We would want to enter buys. So the area that we want to look for to enter our trades would be the lower bound of the channel itself. Now, where we want to look to close our trades, or in other words, to take profit, is on the upper bound of the channel itself. So for example, if you entered a trade right here, the take profit, since we already have our upper bound notated based off of these two highs, our take profit can be located right over here at the upper bound of the channel that we've drawn. So for example, a trade can look just like this. Notice how the lows are our entries and notice how the highs are our take profits. And I'll give you another example right over here, same type of concept. You can see that the highs are getting lower and lower and lower. And you can see the lows are also getting lower and lower and lower as well. So how we would draw this channel here is simply just like this. Here, you're going to be entering your sells. Remember, this is a downwards trend. So you're entering sells and you're closing your shorts down here. Entering sell, closing the trade. Entering the sell, closing the trade. Entering the sell, closing the trade, etc., 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 etc. Now, another form of drawing tools that we use is what we call a support and resistance zone. So go ahead and grab the rectangle tool. You can also access that on the side menu over here where it says rectangle. And essentially, we're going to use these to draw potential supports of zones or resistance. And how we would draw these zones here is we would want to try to make these zones as thin as possible while still trying to encapsulate all of, in this case, it's the resistance zone, all of the highs as much as we can. Notice the price rejected here for the first time, rejected here again, rejected here again, rejected here again, and now the price is still having trouble breaching this area. This is a strong, what we call resistance zone. Why? Because it's essentially creating what's called a ceiling. The price action is having trouble breaching this zone or getting any higher than this. So this could be a potential area for sells, to enter shorts, to enter in the down direction. Now, every single time you see some type of relative high or relative low, you want to make sure you try to identify that area as a potential support and resistance zone. Let me give you an example. We're looking at this low over here, and there's really nothing around it in the past, right? So let's say you saw this low being created. You don't really see anything in the past near it. You would want to mark this zone as a potential low, or in other words, a potential support zone. How would we do it? The way we would identify it is if you see this low that kind of sticks out, you would want to draw a support zone. And the main key point is you want to try to extend the zone to the future, because what's happening here, and I'll enable the replay tool to really make sure you guys understand. What's happening here is you're using this as a reference point of where the price might react potentially in the future. Notice the price had trouble breaching this low. The price reversed and made a U-turn. And now if the price ever reaches this area for a second time, it might be an area where the price might have trouble breaching this a second time as well. So let's go ahead and see this in action. Notice the price is consolidating. And as the price went to this area, notice it reversed on this area. So this is a potential sign of reversal. This could be what's called a double bottom. Notice this is what we talked about in our last category. And the way we identified the double bottom was by creating a potential support zone to see if the price can react at it in the future, thus creating what we call a support zone. Now, the main key point of drawing these technicals, drawing these chart patterns is we want to make sure that we always extend these into the future. It is useless if you draw this channel, but the channel only goes up to this far. You want to make sure you extend the channels into the future because we're using these as potential reference points of where the price might react in the future. Let me give you one more example. We're looking at a high over here, and we're looking at another high over here. So notice I'm drawing this trend line into the future in case the price does end up approaching this area again. This could be a potential area where the price might react. There's no point to draw your trend line and end it over here. This is useless. It is very important that you extend the trend lines and you make sure you use these as potential reference points to enter your trades in the future. Now, the fourth drawing tool that I'll show you in our technical analysis toolkit is what we call the Fib, or the Fibonacci retracement. And essentially how we would use this tool is you would go ahead and select the tool in the toolbar. And the way we use these tools is you want to start the Fib at a relative high, and you want to end the Fib at a relative low. So the way you would draw this is you would enable your first click on the high, and notice from this point, the future price action is going down, right? The next candles are all going down. They're all going down. So you want to draw it in the direction of where the trend was going. So in this case, the price action is moving down. So you would draw it from left to right. You would move the mouse towards the right, meaning the current price action, and you would draw it to the bottom of the relevant low. So now we have our Fib drawn. And remember, guys, we drew it from left to right. Always draw your Fibs from left to right in the direction of where the candles will be painted. What you don't want to do is you don't want to draw your Fib from here to back here. That is not how you draw your Fib. You draw your Fib always from left to right. So in this case, now that we have our Fib, we're trying to ask ourselves and see how far back could the price action retrace before continuing in the original direction of the trend. So if you drew your fib from the top to bottom, that means we're using the fib to look for a sell. If we're drawing the fib from top to bottom, the direction we do the fib in, we do it from top to bottom, that means we're looking for a trade to go from top to bottom, or in other words, we're looking for a sell. It's very important that you understand how to draw the fibs and how to use the fibs. So let's see this in action. So we see here's a relative low, then here is a relative high. So how we're going to use the fib is we're going to start the fib from the bottom because the price action is moving upwards, right? And then we're going to end the fib at the relative high. So now we need to ask ourselves, where could the price retrace to? And a way we can figure this out is using another drawing tool that we use, which was using the rectangle tool, and we can identify an area of support and resistance. I see a clear resistance zone right over here. The price is struggling or having trouble breaching this area. So the price was resisting. Now that the price has actually popped through the resistance area, this could be a potential sign of a support zone. And conveniently, the support zone lines up perfectly with the 50% retracement, meaning this impulsive move has a potential of breathing back around half of the move before continuing in the direction it was already initially going. So we can put a potential buy in the confluence area of the support and resistance zone. And that is our trade. I'll give you a quick hint. The cleanest fibs, the highest probability fibs, are fibs that are either at the 38 fib, the 50 fib, or the 61 fib. In this case, the price lined up at the resistance area and the 50 fib. This intersection point of two technical factors gives us a high probability entry that the price has a chance of rejecting and reacting at the specific area right over here. And notice that we looked for a buy. We looked for a long trade, a buy entry. Why? Because we are looking at an ascending channel. The channel is going up, and it's safer to trade with the trend instead of trading against it. Now, let me give you some main key points and main key takeaways on how you can use these drawing tools effectively. The first key point is, if you need to, if it's hard to kind of identify the trend, the first thing you should do is always zoom out. Look at the chart on a macro scale, because if you're looking at the chart super close, just like this, you're not going to be able to see a lot of price action. So you really won't be able to use the drawing tools properly. So zoom out and you will be able to identify areas where you can use these drawing tools and draw the trend lines and draw the channels and draw the fibs and draw the support and resistance areas. The second tip I'm going to give you is you want to try to draw these zones in the cleanest form possible. You don't want to try to find these obscure support and resistance zones or these obscure crazy trend lines. The cleaner it is, the higher probability that the zone will work or the trend line will work, or the higher probability that the channel will work. Now, the third tip I'm going to give you is if you're looking at a trend line or you're looking at a support and resistance area, you want to find an area that gives you the most touches. The more touches you find, the better it is and the stronger it will eventually hold. Now, the fourth tip I'll give you is you don't want to use these drawing tools as a say-all, end-all. You want to combine these with the other factors that are talked about in this video and the next few factors I'll talk about here in the upcoming few minutes as well. Now, the fourth and final tool we'll talk about is what we call the indicators. Now, indicators essentially use mathematical equations with prior price action to help identify potential areas where the price might react or the direction that the price might be heading in the future. Now, just note that indicators are usually, majority of the time, what we call lagging indicators, meaning it takes historical data to actually plot out the actual indicator. Now, there are thousands upon thousands of indicators that you can find. You can go really deep in the rabbit hole of indicators. How to access indicators on TradingView is that you just simply click this little indicators button right over here, and there are thousands upon thousands of different indicators to play with. Now, this one right here that I have selected is what we call the 50-period moving average. There's a few ways that you can use these indicators. You can use this indicator as a signal of potential directional bias, or you can use this as a potential entry trigger. Let me give an example. So first and foremost, what the 50-period moving average essentially does, it calculates out the average price of in this case, the past 50 periods. In other words, the past 50 candles. It says the price was here and the price was down here. The price was up here. It takes the past 50 candles and it takes the average of that price and it gives you the plot right here. It says the average price for the past 50 periods was 136.034. And note that it's a rolling 50 periods. So now you look at the previous period over here, it takes the next chunk of 50. And this one takes the other chunk of 50. Just to make it a little bit easier so I can show you physically how this works is you take these 50, notice it says 50 bars. It takes the past 50 bars and it calculates it and it spits out the average. And then it does the previous 50 and the next 50 and the next 50. It just goes bar by bar. It's just calculating the average price. So if you go ahead and actually click on the indicator, you can notice the length is 50 and the way it's calculating out the average price, it's taking the close price. It's taking what price did that candle close? Then what price did the next candle close? It's taking the close prices and averaging them out over the course of 50 periods. And by the way, all indicators, you can double click them to pull up these type of menus. So you can always adjust the style, the visibility, and the inputs on every single indicator that TradingView has. Now, the first way people use these to their advantage, they use these as a potential sign of a dynamic support and resistance. They look at price as it approaches the dynamic support and resistance area. They see that the price might have a probability of reacting and rejecting at it. In other words, reacting and rejecting at it, and reacting and rejecting at it. So they look at these as a dynamic support and resistance as an entry trigger to enter a potential trade. Right here, the price pierced through it, yet had trouble breaching it. So this is a potential sign of a sell signal. And you can continue to see potential sign of a buy signal, buy signal, buy signal, buy signal. So that's one way to use these indicators. The second way people use moving averages are just to simply get an idea of the market direction. And how this works is if they see the price action, if they see the candles are majority of the time above on the higher echelon of the indicator, that means this is a bullish trend. You notice that the price action in general is above the indicator. This shows that this is a bullish trend and the market is continuing to go up. Whenever you see the price action dip below the indicator, this shows people a potential sign of selling pressure. So this is a bearish directional bias. So this is where people will start looking for sells. And whenever they see the price action going back up above the indicator, this shows bullish pressure. So now it is an area of time where people are looking for buy signals, buying areas. So in a situation like this, where the price action has majority of the time been above it, above it, above it, as soon as the price broke all the way below it, the price plummeted because the traders that are using the 50-period moving average, this signals to them a potential reversal of the trend. And now there's a lot of selling pressure for the people who are using what's called the 50-period moving average, which continues to push the price downwards. Now, another indicator I'll talk about, which is very useful, is what we call the average true range. So again, open the indicator window, you can just simply search and type average true range. You can notice I have it favorited, I have it bookmarked. So once you go ahead and click on this indicator, it'll enable that indicator on your chart. And essentially how you can use this indicator to your advantage is you can use this as a sign of volatility to help you determine how far you should put your stop loss. Let me kind of explain what I mean. This indicator doesn't give you any directional bias of whether you should be looking for a buy or a sell, meaning don't think to yourself, the higher that this indicator is, you should be looking for buys, or the lower that this indicator is, you should be looking for sells. That's not what this means. The only thing this indicator tells you, the ATR, the average true range, this simply tells you on average what was the range, how high and how low did the price go during that period over the course of the average past X amount of candles. So in this case, I'll open this indicator up, I'll click on the little settings icon, or like I mentioned before, you can just simply click on the indicator and it'll pull up the indicator inputs. I have it set to 14, meaning what it's doing is it's taking the past 14 candles and giving me and spitting out how volatile the past 14 candles were. So you'll notice if I put my mouse on this bar over here, it'll tell you how volatile the price action was over the course of the past 14 candles. So you can see it was around 115 pips of volatility on the daily time frame. And the rolling 14 periods from this candle, it was 121 pips. Here it was 123 pips. Here it was 122 pips. That's how volatile up and down each daily candle was on average in the past 14 days. And it is very important to see what time frame you're looking at, because if I go into the 1 hour time frame, now it's taking a look at the past 14 1 hour candles. So in this case, you can see how volatile this pair was. It was volatile by around 16 pips. And here was around 16 pips. And the previous candle, another 16 pips. And here's 17 pips, 18 pips, 18 pips. So if you were going to use this indicator to help you with your stop loss, how you would employ this is you would go ahead and let's say you want to enter a buy position and you see the average volatility is around 16 pips right now. You could set your stop loss at a 1-to-1 ratio of the distance of the ATR. So around 16 pips is what I've made the stop loss here. Or you can do any multiple of the ATR. So let's say you're a little bit more conservative, and let's say you're someone who wants to put your stop loss 2 times of the ATR. So in other words, 32 pips. And the reason why you would do this is because every market condition is not the same. Every pair that you trade is not the same in terms of volatility. So if you notice that this pair isn't too volatile, you don't want to have a massive stop loss because that's going to hurt your risk to reward ratio. So if you know that this pair isn't too volatile, and if you know on average, every 1 hour increment, the price will fluctuate on average 16 pips or so, this gives you enough breathing room as long as you identified the right entry. Let me go ahead and contrast this with another pair. Let's do GBP NZD, which is inherently a lot more volatile. We can see that this, on average, the average number of pips during the 1 hour period that this moves is around 23 pips, 24 pips, 24 pips, 25 pips, 26 pips. You can kind of see the volatility here. So on this pair, if you were trading this pair, your stop loss would be bigger. So your stop loss could be 28 pips if you were trading 1-to-1 ratio of the ATR. Or if you were someone who's trading double, it could be around 50 to 60 pips in terms of stop loss on the 1 hour chart. Now, there are thousands upon thousands of indicators that you can possibly choose in your arsenal. You just have to take the time to learn the indicators. You can use the Ichimoku cloud. You can use the Bollinger Bands. You can use the pivot points. You can use the MACD, the RSI. There are so many countless indicators under the sun. You just have to find the indicators that work best for you and your trading style. Now, to recap indicators, the main reason people use these is to understand the current market condition, and it also allows you to find and identify a zone of interest, an area that where you would want to enter your trade. It also allows you to identify and determine where you want to cut your losses if the price goes against you, and it's also used as an exit trigger to exit your trade whenever you're in a winning trade. So it can be used as an entry trigger and also an exit trigger. Now that you guys have fully understood the 4 categories, let's put all of this together so you can actually see this stuff in action. So the first thing we would need to do is we would draw our support and resistance zones. So we want to look at all the extreme highs, all the extreme lows. You want to look at all the different points where the price is reacting and rejecting, and we're going to draw our zones. And the main thing we're going to do is we want to make sure that we extend these into the future. Why? Because these are going to be reference points where the price might react in the future. I'm just looking at all the extreme lows, all the extreme highs, and I'm basically just marking them down. So what I'm trying to do is I'm trying to encapsulate as much of the wicks as possible, all the lows, all the highs, while still trying to keep them as thin as possible. Now, the next thing I'm looking to do is I'm looking to draw any trend lines or channels that I see. A trend line that is relevant and useful right now could be one that starts from up here and then connects this next high. And the main key thing is I want to make sure I draw it to where I extend it into the future, because we're going to be using this as a potential reference point in the future. I'm trying to get the trend line to the tip-top edges of the wicks as much as I possibly can. Now that I've drawn the relevant technicals, I've used the drawing tools that I see are the easiest and cleanest. Now the next thing I want to look for any signs of confluence. I want to look for any areas where things are intersecting. An area where I see things are intersecting right now is just simply this. This is just an area where things are intersecting. This would be an area where I want to look for. This is going to be what's called my first zone of interest. So if the price approaches here, I want to be looking to potentially enter a trade. So the price has breached this zone and it has pulled a relevant low. Now the price looks like it is approaching this area. So now the next thing I can do to further give myself confluence is see if there is a fib. And how we would draw the fibs is we want to look at the most recent relative high and then do our first click there. And then we want to look at the most recent relative low. Notice this is the lowest point. And we want to draw our second click there. And we want to see if there is any area that is intersecting. So a few areas that's kind of intersecting is the 50 fib and the 38 fib. So somewhere in this area, there's a few key factors that are indicating that this might be a nice area to enter a sell. So if at this point we want to prepare a sell, there's a few things we need to take into consideration. First, if our entry is going to be on this intersection, we need to figure out how far do we want our stop loss to be. And how do we figure that out? We look at the ATR, the average true range, and we notice that ATR on average is around 32.7 pips. So we move the stop loss, adjust it. If we wanted to do a 1-to-1 ratio, we would just move the stop loss to 32 pips. And now we need to figure out where we want our take profit to be. And a simple way to put our take profit is just like right before the next zone. So now we have our trade set up, we have our entry, and we have our stop loss, and we also have our take profit. Our entry gets triggered. We want to make sure we have enough buffer based on the ATR. We can look at the recent ATR just to make sure that everything is accurate. The ATR shows it's around 36, so we can adjust the stop loss to around 36 pips just to be safe. We see a shooting star candle formation. We see 3 red candles. So at this point, our take profit got hit. So now this trade is closed. Let's continue. The price reacted nicely on this support and resistance zone over here. Price is having trouble breaching this support zone over here. So we see a brand new resistance zone that just got created. Notice the price was reacting in this area multiple times. So we can go ahead and draw this as a potential zone as well. Price reacted nicely on this resistance zone. Now we just need to make sure that the support zone will hold. So now we see the price is actually squeezing, creating a bilateral chart pattern. Notice it's creating a symmetrical triangle. The lows are getting higher and higher, and then these highs are getting lower and lower and lower. And now the price is squeezing in between these two bounds. Now we notice that the price action has breached this bilateral pattern, so we can enter another buy here. And we also notice a 3 white soldiers pattern over here. This shows a lot of bullish pressure. And our stop loss, we're looking at the ATR, 26 pips. So our stop loss would be around 26 pips. So we can have 2 options of our take profit. Our first take profit can be at this first resistance zone, but if this doesn't give you a good enough risk to reward ratio, you can take what's called partial profit, close half of your trade here, and then you can close the rest of the trade at the next zone. So this way we can secure some profits, close some of the trades at this resistance zone, and then if the price does end up breaching it, we can close the trade in full at the next zone. So this first TP was hit. So now let's say we've closed half of our trade, and now the rest of the trade is continuing to run. Okay, so the final TP hit. So now the price is at this support and resistance zone. And matter of fact, we can adjust this zone over here to encapsulate this new high, and then also to encapsulate this small little wick that we see over here as well. So if this resistance holds, this might be a good potential area to enter a sell. Okay, so this zone looks like it is no longer relevant. So I'll close that over here. And now this resistance area matches nicely with this support area over here. So I'll go ahead and draw this as a support and resistance zone as well. Now the current price action is approaching this next zone over here. I don't see any confluences. I don't see any matching technicals that are supporting this zone. So let's go ahead and try a fib, see if there's anything there. So again, how to draw the fib is the lowest, most recent relative low all the way to the most recent relative high. Once we have our zone drawn, now we can look for any confluences. I see the 61 fib matches nicely with this zone, so we can try to enter a potential buy in this zone as well. And then the stop loss, we would have to look at the ATR. It's around 31 pips, so I'll move the stop loss to around 31 pips. And then the take profit would be just this next zone, the same zone back up over here. Our entry got triggered. The take profit got triggered. And notice what this candle is showing. This is showing a shooting star candlestick formation at the resistance zone. So what we're looking at right now, we're looking at a potential double top at a resistance zone, and we're looking at a candlestick confirmation, which is a shooting star candle. So we can actually enter a sell. We look at the ATR. The ATR is showing 33 pips. So the stop loss would be around 33 pips. And this is a pretty safe stop loss because it is indeed above the zone, which is also good as well. And then the take profit would be same thing, just at the next zone. Now at this point, this trend line is irrelevant. And then this trend line can be adjusted to hit the bottom of the wicks. So I do see another intersection area right here. So this might be a decent area to enter a potential buy if the price reaches this area as well. The price was riding within the stop loss for a little while, which was a bit dangerous. Now, as the price is approaching this confluence over here, we can go ahead and schedule another potential buy limit somewhere in this area as well. Stop loss, we're looking at a ATR of around 27 pips. Stop loss would be around this area over here. Good candle, nice rejection candle. And then there we are. Now, hopefully that gives you a clear understanding of how we take all of these different categories, put them all together to create ourselves a strategy to help us find high probability entries and allow us to find the right nice areas to put our stop loss, and also to help us identify areas where we would exit the trade if the trades do end up hitting take profit. So the main key thing that you should take away from this video is you're not using any one of these categories to your advantage. You want to try to use multiple different factors. You want to try to using all of the different technicals, all 4 different categories to give you the highest probability setups. So what did we talk about today? Today, we talked about the candlestick patterns. Today, we talked about the chart patterns. Today, we talked about the drawing tools, and we also talked about indicators. We use all 4 of these things. They all have their own advantages to help us identify MZES, which again stands for market structure, zone of interest, entry trigger, stop loss, and take profit. Now, guys, this is just the tip of the iceberg. There's so many different tools and things that we use to identify high probability entries, high probability trades that allow us to get an edge in the markets. You don't have to be right 100% of the time. You just have to be right more times than you are wrong. And as long as you have a proper risk management strategy in place, you'll be able to grow your account over and over again and take an account from 10,000 and get it to 20,000, get it to 100,000, get it to 7 figures and beyond. It's not going to happen overnight. It will take some time, but as traders, we must learn to possess the discipline to do things the right way and be patient with our trading. And for those of you who do want a little bit of more information, maybe you want some personal guidance, we do have a paid program called Market Makers University Coaching Program. There's a link in the description. You can get all the information about that in the description as well. It's not for everybody. This is for people who want a little bit of hand holding. Maybe you want someone looking at their charts and making sure they're doing everything right, making sure that if they do something wrong, it gets corrected before it builds into a bad habit. This is for people who are looking for personalized mentorship from me and my team to make sure they're on the right track, doing the right things to grow their account. Now, that being said, I know this video was a lot to take in. So if you need to watch this video a second time or a third time, if you need to slow it down or rewind to certain parts and look at it slowly, feel free to do that as well. Share this video with people you feel would benefit from this information, looking at these trades and being able to understand the mindset of a trader. And if you like the information that you saw, feel free to drop a like on this video and subscribe to the channel if you haven't already, because we release trainings and videos just like these on a consistent basis. That being said, if you do have any video ideas that you want me to go over, feel free to drop that in the comments down below. I'm always looking at the comments, always reading them, and we can even just hang out and chill in the comment section as well. That being said, take care, and I'll catch you guys in the next video.